Welcome to Taking Stock for the week ending the 27th of March 2026. I'm your host today, Matthew Swartz, the Senior Portfolio Manager for our funds business. And today I'm joined by Senior Equities Analyst Jason Yin. I hope you're well, Jace.
Hope you're well, Matthew. Thanks for having me.
But before we begin, a reminder that the information discussed in this video is general advice only and does not take into account your personal financial circumstances, objectives, or needs. You should consider whether the information is appropriate for your situation before making any investment decisions. With that out the way, Jason, it's been yet another very volatile week in markets, and the story is entirely focused on the war in the Middle East. So much mixed messaging around escalation or de-escalation has the market struggling to figure out how exactly they should be pricing this. We've seen repeated strikes across energy infrastructure from gas fields to export hubs, and more importantly, the Strait of Hormuz remains effectively constrained, which is the critical artery for global oil supply. What that's done is inject a real supply shock into energy markets. Oil pushed back above $100 a barrel during the week, and while we've seen some pullbacks, the volatility has been extreme to say the least. We're literally observing 10% price swings on Donald Trump's Truth Social posts within minutes.
Yeah, and that's the thing, Matthew. It's not just the conflict itself; it's the unpredictability around this whole thing. Look, Trump's fingers in terms of tweeting and messaging are literally all over the place. One day we're talking about strikes, the next day he's talking about negotiations, and then we've got delays and so forth. And the markets have really started trading on this pattern.
Well, at least trying to, isn't it, Jason? But look, there's a term for it. It's called the taco trade. Trump always chickens out. But the problem is that only works until it doesn't. We saw that early in the week, Trump delayed strikes on Iran's energy infrastructure and oil dropped sharply. Equities rallied, and this all happened within minutes. And then again, tensions flared up and the oil price did push higher again. So markets are effectively being whipsawed at the moment by geopolitical headlines rather than trading fundamentals.
Yeah, and that's flowing through to the broader market as well, Matthew. The AXX had a bit of a bounce off the lows, but couldn't really hold some of the highs that we observed this week. It feels like that every rally is being sold into a little bit as well. And also interest rate expectations are rising. And this is the market pricing in another 3 potential increases for the rest of the calendar year.
Yeah, that's right. That's the concerning element, isn't it, Jason? There's a growing sense of buy the dip fatigue. Investors just don't have conviction right now. And if you zoom out a little, the macro implications are fairly clear. Higher oil feeds directly into inflation expectations. We're already seeing bond yields remain quite elevated, and that's not a great backdrop for equities, particularly stocks in that growth sector.
Makes sense. So if we were to break this down in terms of sector performance, who's actually winning and who's actually losing in this environment?
Well, energy is obviously the big beneficiary. Oil and gas producers are seeing a direct uplift from the higher realized prices. But if we dig a little deeper beyond that, we're seeing a rotation back into your traditional defensives. So we've got telcos, staples, and utilities. And these are businesses with more predictable earnings and they have pricing power, which becomes really important in a volatile macro backdrop. On the flip side, anything more cyclical or trading on high multiples, such as tech, healthcare, materials, and some consumer discretionary names, continue to experience real pressure. This week in Under the Microscope, we're looking at star income stock Telstra, and specifically the latest pricing changes across its mobile plans. The company announced increases across both postpaid and prepaid, with most postpaid plans going up about $4 a month and the prepaid closer to $5. Importantly, it's coming through earlier than last year, early May rather than July, which is quite a deliberate move. Jace, what do you make of the timing? Because bringing that forward isn't something they've typically done.
Yeah, it's definitely an interesting chase of change in tactics. Bringing the price rise forward does mean two things. Firstly, it pulls forward the earnings benefit, so you do get more of an ARPU, which is average revenue per user uplift through FY26 and into FY27. And also, secondly, it gives Telstra flexibility heading into the end of financial year period. And if you want to lean into the promotions or discounting during that busy window, then they've already locked in that higher base in terms of pricing. So tactically, it seems quite smart.
And I guess the bigger questions investors have had is, can Telstra actually keep pushing through price increases in this type of economic environment?
Well, I think that's the key debate around markets right now. You've got a pretty cost conscious customer at the moment, given what's happening in terms of energy markets. So there's been some skepticism around how much pricing power Telstra really has. But this move probably answers that, and at least in the near term. The increases are actually a bit larger than what the market was anticipating. And the fact that they've gone early suggests that management has a fair bit of confidence in the sustainability, or at least the pricing power of its mobile business.
So what do you think this means for earnings and growth looking ahead?
Yeah, I mean, the most immediate impact here is obviously an increase in ARPU, which is average revenue per user. These price increases should drive solid ARPU growth across both the mobile portfolio and also should flow pretty directly into mobile services revenue as well. The current thinking in the markets is if you're looking at mid-single digit growth, then that would translate to around 5 to 6% also into FY27. Having said that, there will be some offsets, Matthew, which will be in the form of maybe a little bit of a churn in terms of customers choosing to move to lower plans. But on the net basis, the pricing should more than offset any churn that the company may experience.
Okay, so overall, it does sound as though they're really leaning into yield rather than chasing subscription growth. And speaking about yield, this also does support the company's ability to pay a very healthy 6% grossed up dividend yield.
Yeah, that's exactly right, Matt. And in an environment where inflation is still a factor and costs are elevated, companies can pass through price increases, are in very strong position. Telstra is showing that it can do that in this environment. So that's a positive for us.
So at the end of the day here, we've got a business with relatively defensive earnings, improving average revenue per user, and a healthy balance sheet to support an attractive dividend yield. That's why it continues to hold up in this market.
Maddie, I know you've been across the country this week speaking to some of our members in Sydney and in Brisbane. And this is probably a question that has come up in conversation, which is what's the fund's current portfolio positioning in light of this market environment?
Yeah, look, as you know, Jace, we're numbers driven and bottom up, but I think in this type of environment, the key theme is obviously holding some discipline. We're not trying to chase short-term moves or predict the unpredictable in the age of Trump and his erratic decision-making, to say the least.
Mm.
But from a positioning perspective, I think what we've done recently is added exposure to energy in February, and that's not because we're trying to time oil. It's because the businesses are generating strong cash flows at current prices. So it's not about making big macro calls. It's more about owning the right businesses. In this environment, stock selection matters more than ever. With high uncertainty, it's not the moment to be speculating on what could be the next big thing, but rather selecting or holding companies with earnings resiliency and balance sheet strength. At the end of the day, a company with little debt and a good cash buffer are much better positioned to navigate economic shocks than those that are fully reliant on capital markets to fund their strategies. But as always, big volatility will oftentimes create incredible buying opportunities for those that are patient and unemotional.
Yeah, and I think that's a really good point, Matthew, which means don't really get caught up or too tied up in reacting to every single headline that we read every single night.
That's it. I know to our members, it might sound like a broken record, but stick to quality, focus on earnings resilience, and be selective. Because while the macro noise is loud right now, over the long term, fundamentals still do drive returns. So that's all we have time for in this very volatile week. Let's hope that common sense prevails over the weekend and this conflict gets steered towards a path of permanent end to hostilities. Thanks so much for joining me, Jason.
It's a pleasure.
And if you have any friends or family who you believe would benefit from Stock Doctor subscription, please feel free to share our referral link. We grow and innovate because of you, our supporters. Until next time, have a happy, healthy, and prosperous week ahead.